Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Tuesday, September 30th. Tuesday's session marked the S&P 500's best day in 6 years after having its worst day in 21 years on Monday. Buying interest was fueled by short covering, bargain hunting, and increased optimism that the government will reach an agreement on a financial relief plan before the end of the week. The stock market settled near session highs with all 10 sectors posting a gain. Financials led the way with a 13.1% gain, followed by a 5.8% rise in energy stocks. The utility sector underperformed on a relative basis, gaining just 1.3%. The S&P's advance of 58 points, or 5.3%, is more than half of Monday's plummet of 106 points, or 8.8%. The catalyst for the selling on Monday was a rejection of the financial relief bill by the House of Representatives, which sparked concerns that the increased turmoil in the credit markets would weaken the broader economy. To that point, credit markets did in fact tighten further. Overnight dollar LIBOR, which measures the rate banks charge each other for overnight loans, spiked 431 basis points to 6.88%. LIBOR increased across all terms, which range from overnight to 12 months, indicating that banks were very reluctant to lend to each other. The Fed's aggressive measures to increase liquidity, including a $20 billion 28-day repo operation earlier this session, did have some benefits as the session progressed. Prior to the stock market open, the Fed funds rate, which is the interest rate that depository institutions lend their Federal Reserve balances to other depository institutions, rose as high as 7%, according to Reuters. The rate then retreated to 1.5%, which is below the Fed's target rate of 2%. As stocks rose, Treasury gave up much of the previous session's gains as investors showed a greater willingness to take on risk. The benchmark 10-year note dropped more than 2 points, sending its yield up to 3.83%. In other developments, the SEC and the Financial Accounting Standards Board will issue guidance on how assets are valued for inactive markets. Presumably, if the FASB allowed financial firms to value inactive assets at their model value instead of market value, the amount of write-downs will decrease. There was not much in terms of corporate news, although there were several economic items. Consumer confidence in September unexpectedly rose to 59.8, which was better than the expected reading of 53. While this headline is good news, it does not give a full picture of current sentiment, as it does not capture the latest market turmoil. Manufacturing in the Chicago region continued to expand in September. Regional Manufacturing Survey, Chicago PMI, fell 1.2 points to 56.7, which was better than the median economist estimate of 53. A reading above 50 is intended to represent growth. Home prices retreated in major metro areas in the month of July, marking the 25th consecutive month of price declines. According to the S&P Case-Shiller 20-City Composite, July prices are down 16.3% compared to last year and fell 0.9% from June. The dollar rallied 2.6% against a basket of world currencies, getting a boost on news that another European financial firm needed to be bailed out by European governments. The strength of the dollar helped limit the gain in commodities to only 0.7%, although crude oil managed to rally 5% to 101.24 per barrel after dropping 10% in the previous session. The extreme moves in the stock market over the previous two sessions was a fitting end to a tumultuous third quarter. For the quarter, the Dow, NASDAQ, and S&P 500 declined 4.4%, 9.2%, and 9% respectively. I'm Pat O'Hare for Briefing.com. Thanks for listening, and have a good evening.